Hi, everybody. It's Dr. Robinson. It is the November 10th, 2022 meeting of the Money Masters Investment Club. Our itinerary, pretty similar to what it's been for the last several weeks, or months actually. We're going to go through our financials and we'll do a broad-based market update. I have had a little bit of optimism, or I do feel a little optimism in the market right now. I think we may have turned a little bit of a corner. I'm not entirely sure it's long term. But in the short term, and by short term, I'm talking about over the next couple of months, maybe through the end of the year and maybe into January of next year, I'm a little bit more bullish than what I've been recently. I'll explain why in just a bit, but I do have some charts to kind of explain why I'm feeling a little bit more bullish in the market, and maybe it's time to start dipping our toe back into the market a little bit on a dollar cost averaging basis. Having said that, let's take a look at our financials real quick. We had a really good week for the over the last 7 days or so. We started a week ago, 11/2/22, at $22.53. We had a gain of $1.57. Our ending NAV was 24.10. That gave us a return of just under 7% for the week. Really good end of the last week and the beginning of this week. We had some really good numbers. It slowed down a little bit this week. Towards the end of the week, we had some really big market movers yesterday and today. The market, and of course today is the 11th of November, but today the market was really hard, really volatile. We're seeing a lot of volatility, even though the VIX has come down quite a bit. We're starting to see some really big candles, and it's messing with us a little bit, but we'll get a grip on that. You will notice down below the gains versus losses, we did have some redemptions. Now, normally redemptions don't affect our net asset value, but remember I've told you that we are fully invested, and so there is some money that we've got tied up in a strangle, a long-term strangle, and when I have to redeem any of that, I have to redeem it at whatever the net asset or whatever the price of that option is at that moment. We ended up taking a little bit of a loss on the redemption, so there is a 28-cent correction to our NAV just simply based on the redemptions that we've had over the last week or so. So our true net NAV right now, as it stands, is 23.82. So the 24.10 is if we didn't have any redemptions, but with the redemptions, 23.82. It does affect us, and that's why I've kind of said a couple of weeks ago, you want to try to give me, if you're going to do a redemption, we want to try to do a redemption, or give me as much advance notice ahead of time so that I can make sure that we can time that as best as possible when it comes to redeeming shares of the strangle. Speaking of our strangle, we still have an unrealized gain there. It's better than it was 2 weeks ago or a week ago. A strangle remains positive. Our calls are in the money by $1.47, so we have increased the spread there. Mostly as a result of the last couple of days. We've had the market's been on a tear the last couple of days. If you've paid any attention to the markets, I'm sure you have. Our puts are actually out of the money right now. So out of the money just simply means that there's no intrinsic value in them. We're down 67 cents on the puts. Not unexpected when you have a day like you had yesterday, where the Dow Jones yesterday on Thursday was up 1,200 points, and another reasonably good day today. But we do have an unrealized gain here, $227,000. So we're still holding our own there. So we'll keep that going as long as we can. I did when I did the redemptions here, I went ahead and updated our puts. So they are out of the money here, but if I had left them alone, we would have been a lot more out of the money. But I did this on Tuesday of this week, not in anticipation of what happened on yesterday, but just in generalities for doing the redemption. I went ahead and updated the deltas on the puts to get them up more in line. And so as we stand right now, we're up $227,000 on the strangle. So we're doing pretty well there. As you recall, over the last several months, we've been following the bond market, and you can see a big difference or a big change in the bond market. The bond market rallied hard this week, just like the stock market did, of course. We also saw a retracement in the dollar. I've been telling you over the last several weeks or months that as long as the bond market or bonds were increasing in interest rates, so as long as interest rates were going up and the dollar was going up, that was going to keep a lid on the stock market. Well, those two things did reverse this over the last few days. The bond market has been on a rally. Now, remember, bond prices are inverse to interest rates. So if interest rates go down, that means bond prices are going up. And bond prices went up big over the last few days. That means that interest rates have come down quite a bit. And the dollar has come down quite a bit as well. Just a few weeks ago, the dollar was at 113. The last time I looked, and it was early this morning, it was at 109. So it's come down. Now, it doesn't sound like a lot from 113 down to 109, but a 5 cent move on the US dollar is a huge move. I mean, it's some of the biggest moves in history. So just seeing the dollar move that much in such a relatively short period of time has just basically lit a fire under the stock market. So the stock market is roaring, especially yesterday. If you didn't pay attention to yesterday, the Dow Jones was up about 1,200 points yesterday. The S&P, the Nasdaq market, and even the Russell 2000, they were all up 5 or 6%, depending on which market it was, but roughly 5 or 6%. Those are huge gains. We've never really seen that much like that. There's only a few times in history where you see moves that big. But because of that increase, and we'll talk about what caused it here in just a bit, but just because of that increase, we've seen bond prices accelerate. That means the yields have come down. So over the last week or so, we've seen the 1-year Treasury go down by 17 basis points. So again, when yields go down, that means the bond prices are going up. So the bond investors are really happy this week because they're seeing those interest rates come down. The 2-year bond is down 38.2 basis points for the week, 46.1 on the 3-year, 43 on the 5-year. Look at the 7-year, 39 basis points decrease. And then on the main one, the one that we pay attention to the most because it's the most economically relevant, 33.8 basis points on the 10-year bond. Just before everything happened yesterday, the 10-year bond was well over 4%. It was about 418, 424. And in a matter of a relatively short period of time, it just dropped like a rock. Same thing with the 30-year bond, although not nearly as much as the other bonds. It was only down 12.8 basis points. 6-month T-bill, 4.5. That's a decrease. Look at the mortgage rates up in the upper left-hand corner. Now, last week when we gave you the mortgage rates, they were well over 7% on the 30-year. So they've come down a lot. Now, I don't think it's come down enough to justify a lot of people thinking about buying houses or anything. I don't think we're going to see an uptick in mortgage applications with this because it's still at 6.75. But of course, 6.75 is much better than a 7. I don't remember exactly what the number was last week. I think it was about 7.2. But when you talk about a 7.2 versus 6.75, that's a big change. I'm not entirely sure it's going to, light any fires under real estate sales, but at the end of the day, it's moving in the right direction if you're in the market for a house. 15-year mortgage down to roughly 6.5% for a 15-year mortgage. So at the end of the day, we've seen a huge decrease in yields on bonds, corresponding to the thing that triggered this yesterday. Having said that, let's talk about what caused it yesterday. Now, this is the year-over-year CPI numbers, and that's what caused the market reaction yesterday, by the way, guys. CPI numbers, the Consumer Price Index, that's our inflation guide. It's not my favorite one. It's not one that's really relevant in the real world because we have two different versions of this. We have core and non-core. But when you look at the CPI numbers, the blue line is the one that's most important there. Came in, if you follow that blue line, you can see over there from October of 2022, came in at 7.7. Now, that's still a high interest rate. I don't care how you look at it. I don't care, where you're from or what your political beliefs are or anything. That's a really high number. And from an economic point of view, we would normally expect the market not to be doing well with a CPI number of 7.7 or inflation rate of 7.7. The difference, though, or the issue here was that the economists were actually expecting 7.9. Now, that's only 0.2 difference. But if you're expecting 7.9 and it only comes in at 7.7, it seems to bear out that the Fed is finally getting on top of the inflation issue. Now, remember, up until now, the Fed has been raising interest rates at about 75 basis points each time. Now that we've had a material change, CPI has significantly come down. Not significantly, 2/10. I can't call that significant, but it has come down by 2/10. It kind of implies that we've hit the peak in the CPI. Now, I personally don't think that we necessarily have. Um, if you look at the internals of the CPI, the biggest drop was in auto prices, and used autos, by the way, not the new cars. So used auto prices went down by 2.5%. Um, is that enough to justify, or for me to come along and say we've hit peak inflation? We also had some decreases in some other areas that, again, that are more volatile, if you will. For example, energy costs. Now, energy, if you've paid any attention, gas prices have kind of been volatile lately. Oil prices, whether it's WTI or West Texas, that's at West Texas Intermediate. That's the oil that we mostly use in this country, by the way. But there's also other oils that the rest of the world uses, a little higher in sulfur. But when you look at those oil prices, they're averaging somewhere about a low of 87, 88, and then it pops up to say 92 or 93, and then comes back down to the mid 80s, and then kind of goes back up. So we're starting to see these oscillations. I think that ultimately they're going to have to go higher because we are going into the winter season. A lot of people still, even in the United States, still use heating oil to heat their homes, especially up in the Northeast. So we are going to start seeing some prices increase a little bit. But still, we did have some price decreases in oil that helped, along with the used car prices. It did kind of drive down a little bit on the side of CPI. On the other hand, we're still seeing some higher inflation. Prices were up 1.8% in services. So we are starting to see, or still seeing, some higher inflation in other areas. So I don't think we're over the hump yet, but and I do think personally that the market overreacted to this news. I don't think that 0.2 of a point, decrease in the CPI, or a beat on the CPI, if you want to call it that, is worthy of a 1,200 point run on the Dow Jones, or a 5% run in the S&P or anything. So, but at the end of the day, the market's the market. We can't say the market's wrong. We can't say the market's right, because it's the market, and the market does what the market wants to do. If you spend any time with me at all, I usually call the market Mr. Market, and sometimes Mr. Market can be really stupid. I kind of think that what the market did yesterday was kind of stupid. I don't believe it was justified. A 0.2 increase, or 0.2 decrease in the inflation rate is worthy of justifying such a big rise in the market. But again, at the end of the day, it's the market, and the market can do whatever it wants. So we did see a slight decrease in CPI. We've got another CPI coming out in December. So we'll kind of compare and see if this trend continues. By the way, 1 month does not make a trend, because this is the first month where we've seen a decrease. So it's not like this is a confirmation of a trend. There is no trend. 1 month does not make a trend. So this is just one data point. We have to wait and see what the data points are going to be in December and even into January to determine whether there is actually a peak in the inflation. So maybe it comes out to be that this is the peak. At the end of the day, we don't really know until we have the data. And of course, the data is still a couple of months away. But the market did react to it, and the market is on a tear right now because of it. And this is, again, if you didn't see what happened to the market over the last couple of days, I just kind of summarized a couple of different things here. So this slide just kind of looks at all the different markets. So the S&P 500, you'll notice, was up 5.5% yesterday. It's a huge market. That's a huge run up. The S&P market, right around, started out at 3,800 or so, give or take. So if you add 5.5% to the 3,800, you can see that's just a huge run. The Dow Jones was up 3.7. The Nasdaq was up 7.4. Now Nasdaq, if you recall, is more technology. Those are technology stocks. So the S&P is the market we trade the most. That is the broadest market of all. It's the 500 largest companies in America. That's the market we trade the most, but we could have made a little bit more money in the Nasdaq. But the Nasdaq is a little bit more volatile. But again, it was up 7.4. The Russell 2000, another market we trade frequently, is up 6.1. So that was pretty much in line with what happened in the S&P. The ES, the NQ, those are the futures markets. So you can see even the futures markets had a pretty big impact yesterday as well. So the ES, that's the E-mini 500. So that's kind of it's a mini S&P 500, if you will. That was up 5.8%. NQ is the NASDAQ futures market. RTY is the Russell 2000 futures market. And the YM is the Dow Jones Industrial Market or futures market. So you can see all of those numbers were up big yesterday. But it wasn't just, and I kind of alluded to this, it wasn't just the stock market that really rocketed higher. Look at the FX there is the foreign exchange. You can see the dollar. I told you the dollar had come down quite a bit. It recovered a little bit today, but you can see it went down a total of 2.2%. Down to the low at the intraday low was at 107.87. Now remember, just a few days ago it was at 113. So this thing has gone from 113 down to 107.87. Against the Japanese yen, which is a big currency, it's one of those important currency ratios we look at. The Japanese are kind of breathing a sigh of relief because our dollar's been so strong against their Japanese yen, and now the yen is a little bit stronger against the dollar in terms of where it has been. It's still not as strong, on a dollar-to-dollar basis or a dollar-to-yen basis. But at the end of the day, there has been a correction in that market, which is a sigh of relief to the Japanese. So we saw the dollar decline 3.8% against the Japanese yen. Still a little bit of an increase against some European currencies. They've got their own special problems going on over there. But you'll notice the bonds as well. So the U.S. T-notes, short-term bonds, saw 71 ticks on that. Ticks, think of it as like basis points. 10-year bond, 3.81. So a lot of movement in the bond market. We kind of already looked at the bond market, so I don't need to go any further there. Look at the energy. Oil is up 0.4. The Brent is the other type of oil we talk about. I told you it's the oil that typically Europe uses. It's a higher sulfur rate. In the United States, we use WTI, which is mostly coming from Texas. It's called sweet crude. Sweet because it has a lot less sulfur in it than the Brent does. But either way, you've seen some movement in the energy markets as well. By the way, we saw a movement. A lot of people are expecting to see energy prices come down a little bit, but this kind of news where the market goes up, that theoretically makes business want to expand, and so we would expect an uptick in energy prices because companies would maybe particularly start producing more goods and services. Of course, the more goods and services we produce, the more oil we need to run trucks and trains and planes and all the things that kind of fuel, and electricity too, of course, but all the things to fuel an economy. So we did see some movement in the energy market. Bitcoin, even Bitcoin. Now, Bitcoin is something you don't want to be holding right now. You guys have been paying attention the last couple of days. The crypto market is in chaos right now. It's something I would suggest staying away from. If you're thinking about getting into it, don't right now. I don't think it's gonna be the end of crypto. Some people are calling for the end of crypto. I think that's wrong. But at the end of the day, we don't want to be anywhere near crypto right now. If you are holding stocks like Bitcoin and stuff, or Coinbase rather, it might be prudent either to hold on to it or think about if you've got a decent price, depending on what your cost basis is on it, it may be something you want to chuck for a moment. So we have seen some increases in the crypto, but the losses there are still pretty big from where they were even a year ago, or as little as just a few months ago. So we saw a big move in the market yesterday as a result of 0.2 of a difference between what we expected on CPI and what we actually got on the CPI number. Again, I think it's overdone, but it is the market. It is what it is. So I can't say it's right. I can't say it's wrong. I don't think it's going to be sustainable long term because the Fed has been clear. And in fact, by the way, we did get some comments from the Fed. Some people went to the Fed and said, after the move yesterday, what did some of the Fed members think about it? And a bunch of them wanted to reiterate that we're a long way from slowing down increases in the Fed funds rate. Now, they may slow down the size of the moves. So again, instead of 75 basis points, I do think that they're going to go 50 basis points in December. I've been telling you that for the last 3 or 4 months. Interest rate increases or messing with the Fed funds rates is what we call a lagging indicator. So one of the things that happens is once you make a change in the Fed funds rate, it actually takes a couple of months for that change to take effect. So it's not something that happens immediately. Now, it happens immediately in the bond market. But again, the bond market is not the stock market and it's not the economy. Those are just markets. So when the Fed does something, when they do any kind of tightening at all, it actually takes a couple of months for that tightening to get through the economy. So, here we are in November of 2022, and we're starting to see the effects of maybe some of the Fed tightening that happened maybe in July or even August. So the tightening in July is now starting to affect us now. We're probably not going to see the tightening they did just a couple of weeks ago. It's probably not going to be felt well until maybe January, February. So what's going to happen here is it just makes common sense that going into next month, into December, where they have their next meeting, they're probably going to raise just this 50 basis points because they're going to want to wait and see a little bit about how much effect the previous 4 or 5 75 basis points moves that have happened, how long it takes to those really to affect the market or do the economy, not necessarily the market, but how long does it take for them to affect the economy, to slow down the inflation? We're just now starting to see some slowing in the inflation rate, but it's been several months that they've been doing these 75 basis points. So again, next month, probably 50 basis points. Still, I'm kind of up in the air about the one after that, and I don't even know what the next meeting is. I don't know if it's late January or early February, but whatever that next meeting is after the December meeting, because they happen every 45 days. Whether they're going to do from that point 50 or they may shock us with another 75, but it's probably going to be 50, maybe even 25. Again, it kind of depends on what the CPI numbers are going to be for December and even into January before we have a better idea of what the Fed's going to do in terms of any future increases. We talked a few weeks ago, or it may have been last week, I'm not sure. We talked about a terminal rate. The terminal rate is where we think the Fed is going to stop raising rates. I told you I think it was last week, I told you that I think that, or based on the comments of the Fed from the last meeting they had, that terminal rate could be closer to 5.5. The market has priced it in at right now at 4.8. So the market and the Fed are at odds. Now, if I'm a betting guy, and I'm not, but if I were a betting man, I would side with the Fed. They're the ones who control it. But the market right now is priced in a terminal rate at 4.8, technically 4.83, I think is the last number I saw. Which effectively means that interest rates aren't going to go up much more than where they're at right now. So they don't really expect, they're almost pricing in a December increase and maybe nothing after that. I don't think that's right. I think they're being wildly optimistic about that. But again, who knows if the December and the January February increase or CPI numbers come in significantly lower, we might be at a terminal rate of closer to 4.5 to 4.8, whatever it is. So they may be right. I just don't see that happening. I think the terminal rate, because again, Jerome Powell had said terminal rate is probably somewhere around 5.5 and even closer to 6. If that happens, the market's going to tank again. That's why I told you that while I think that there's some optimism in the market, it's not long term, because I do think that as we start getting some CPI numbers going forward, and we're going to have to watch this. If you dip your toes back in the market, we're going to watch this so that we can be prepared to bail in the market if we need to, as we look at those CPI numbers and realize that they're not going down as fast as we think they're going to do. I actually think that our next CPI number might be a little bit higher than what it was today or what it was yesterday. I have no basis for that in proof. It's just rents, owner equivalent rents is actually 2/5 or 40% of the CPI number. Rents are not going down right now, guys. So I don't know that this is an overly, and I don't want to sound pessimistic because I'm actually kind of optimistic right now in terms of where the market's at. But it does mean that we need to be cautious about where the market's going to be going forward. So I'm a little bit optimistic, but I'm cautious about it. and gonna want to stay prepared to bail or to mitigate some of the risk in the market going forward. So some people have asked, why am I getting optimistic? Well, this is one of the reasons for it, and I don't show this chart. This is not a chart that I pay a lot of attention to for a lot of times because it's a mediocre chart in terms of what's going on in the economy type of thing. But this is a chart. It's called a CTA chart, and this is just a commodities agents. Commodities agents are kind of people like me who I do mostly options. I don't do commodities that much. I do commodities from time to time, especially for clients. I don't do it on a large scale. But commodities advisors are people who are setting up client accounts for whether they want to go long oil or short oil, whether they're going to buy pork bellies and wheat and all the commodities that are out there, including gold and precious metals and stuff. So at the end of the day, there's a lot of money out there that commodities traders they have shorted the market because there's expectation that prices were going to come down. So we expected price for gold to come down, or not so much gold for investment purposes, but gold for manufacturing purposes. We expected the price for industrial diamonds to come down. We expected the price for other things to come down simply because people didn't need them. How much silver do you need if you're not building computers and stuff? Because silver, the biggest use for silver is in the technology world. And if nobody's building computers and chips and all that other stuff, you don't need all that much silver. So the price for silver should, based on supply and demand, should come down. Well, there's $79 billion worth of short covering that's got to occur in the commodities market. And by the way, if you're not sure what that means to short something, or when you've shorted something, basically you've made a bet that the price of something's going to go down. Now, when you make a bet that the price of something is going to go down, you have to cover that at some point. What covering means, you have to buy it back. To get out of a short position, you have to buy the stock, you have to buy the commodity or the option or whatever it may be. So if you trade with me in the morning, you know what that's like. We cover all the time. We just call it selling out the position. I sold at such and such a price. But technically what we did is we covered. We have to buy back the option at that price. So if I'm shorting the stock, I want the stock to come down, or if I'm shorting an option, I want the price of the option to come down. Maybe I bought it at $1.10, and then the market goes down, and the value of that option now is maybe $1.20. I've made 10 cents, and I get out, I sell it at 110, so I've covered the position. Now, technically, what I've done is I bought the position back. I just bought it back at the lower price, even though the market works inversely on that. But in any event, what I've done is I've covered the position. Well, commodities people have to cover these positions. So people have shorted oil, they've shorted some other things, and now they're going to have to cover them. To cover them, that means they have to buy it. Whenever you buy it, remember, supply and demand. Whenever you buy a lot of stuff, the price of that thing goes up. So what's going to happen here is we've got $79 billion worth of commodity shorts that have to cover. Now, I'm not saying they have to cover all right away. Some people are willing to hold on in the hopes that the market corrects and comes back down. But assuming the market continues to go up, and I think that's a pretty safe bet for the moment. For we're getting into the Christmas season here, and we call it a Christmas or the Santa Claus rally. It's likely the prices are going to continue to melt up. As prices melt up, more and more of those investors are going to have to cover their positions, which means they have to buy it. So that's just going to drive up the price of the stocks or the commodities even higher and higher and higher. So that's going to be bullish in the market. Gold prices are probably going to go up a little bit here. Oil prices we would expect to go up, but also some of the prices or the commodities for long-term things, green beans or soybean and all those other things that go out there, prices for those are probably going to go up. Now, that does pose problems on the CPI side of things, but this is mostly a financial issue as opposed to more an inflationary issue. But we are going to start to see some prices of things go up simply because we've got a lot of short covering that's got to be done. $79 billion worth right now. Pricing at 50 basis points rate hike by the Fed in December. So again, I'm optimistic because I do think the Fed is going to slow down the increases in, they're not going to do the 75 basis points in the future. Again, I don't have any evidence or proof of that. It's just, I think the market's priced it in. I kind of expected it as well to be 50 basis points instead of 75. The CTAs, I just talked about this. The current commodities traders have to cover $79 billion in short positions. That is hugely bullish in the market. Terminal rate, we talked about this. I said 4.83. I guess it's actually 4.89. So the terminal rate has fallen to 4.89 as a result of Thursday's action. So again, we were looking at a terminal rate on Fed funds rate at 5.5, maybe 5.75 potentially. Now it's down to almost 100 basis points from where we thought the terminal rate might be. So that's bullish on the market. Corporate buybacks. Now this came from this wasn't any research I did, by the way. This came from I think it was Morgan Stanley. Morgan Stanley reported that corporate buybacks right now are averaging $5 billion a day. Now, keep in mind what that means is a company's buying back its own stock. So Apple might be buying back its own stock. Well, remember, in economics, it's all based on supply and demand. So if Apple is buying back its own stock, that leaves fewer shares of the stock available to the public. And of course, the valuation of the company doesn't change. So if the company is valued at, let's just say, $1 trillion, if Apple has $1 trillion of value and there's 16 billion, because there's roughly 16 billion shares of stock outstanding. So if you divide the $1 trillion by 16 billion, you get the current market price of the stock. Well, if Apple buys back some of that stock, the value of the company is still $1 trillion. That doesn't change. But now you're going to divide it by maybe 15.5 billion shares. The price of the stock goes up. So again, even though there's no change in the economics of the stock automatically goes up in value simply because there's fewer shares available to the public. And of course, whenever there's fewer of something in the marketplace, the price of that thing goes up. So we are seeing $5 billion a day through the end of the year. And Morgan Stanley did say that this was going to continue through the end of the year, mostly for tax purposes and stuff. But again, if you're buying back $5 billion a day of stocks, it's not just all Apple, by the way. I don't want to make it sound like it was all Apple. But if a company's buying, or companies are out there buying back their stock at the rate of $5 billion a day, that's a lot of money. We're still roughly a month and a half away from year end. So we got another 45 days at $5 billion a day. That's bullish in the market. And then the last one is, and I've kind of alluded to this when we talked about the CTAs. Remember, they've shorted the market. There's a lot of other people that shorted individual stocks. There's a lot of people out there, and Tesla is still one of the most highly shorted stocks in the country, for good reason. I think the stock is overpriced. But at the end of the day, if the market kind of continues to go up like this, those shorts are going to have to cover. You can only tolerate losses for so long, so you're going to have to cover. And remember, to cover means you have to buy the stock. So there's going to be a bunch of people buying some Tesla stock and some other things just to get out of those positions, out of those short positions. And remember, to get out of a short position, you have to go long. And once you go long, of course, now you've bought the stock, and that just makes the value of the stock go higher and higher. The more buyers you have, the higher the price of the stock. So I am optimistic in the market simply because all the activity we're seeing here in terms of where the market's going to go over the next 45 days or so. I'm not saying that I think this is going to continue necessarily into January, February, March of next year. I'm not saying that at all. So I am optimistic for the moment. What I've been thinking I would do, there's a couple of stocks or a couple of investments I think that might be appropriate here. I'm going to publish them this week. I am, as I do this thing, I'm getting prepared to leave for Florida again. We had another hurricane just a month after our previous one, and it hit my town again pretty hard. I'm heading down there to see any further damage. It's not like I can lose any more. The building is pretty damaged, but in any event, over the next couple of days, maybe Monday and Wednesday of next week, I'm going to start doing some recommendations I think might be appropriate for at least the next 45 days. Whether we go long term with these or not will depend on what goes on in the economy and what's going on in the markets. But I do think it's time to maybe dip our toes into some things, and I've got a couple of things I picked out, and I'm going to do a little write up on them, and I'll probably just publish it the way I do this, just put it on the YouTube, and you guys can listen to it. And if you want to take action, I'll tell you what price to buy these and where your entry points and exit points should be and all that sort of thing. But in any event, that's the meeting. I know it went a little longer than I thought, but if you have any questions, as normal, send me an email, text question, whatever it is, and I'll get back to you as soon as I can. Other than that, guys, we'll see you in about a week or so. Have a good night.